Hi, this is BloombergQuint and I'm Menaka Doshi. Now, as you all know, we scaled 13,000 on the Nifty yesterday. We're trading well above that this morning. The Dow on Wall Street scaled 30,000 last night. What happens now is the question that all investors are asking. Are markets poised to catch their breath? And I mean both global markets and Indian markets. Or is it time for a second wind? Or in Milind Karmarkar language, is it time for the marathoners to take a pit stop and for the relay runners to pass on the baton? Milind, welcome to Talking Point. Good morning, and thank you for being here on BloombergQuint.
Good morning.
I just want to start by getting a quick reaction from you on these milestones that we seem to have scaled, both in the Indian markets as well as global markets. But more importantly, the speed with which we covered the last round of the last mile, right?
Yes.
The last 1,000 points on the Nifty was what, some 12, 14 trading sessions?
Yes. So let me just, go back slightly and just take a review of what has happened in the last 12 years. So if you see for the last 12 years, that is from the peak, which probably happened in January 2008 up till now, the compounded growth rate of market has been just 6%. While as the economy has grown probably faster than that in nominal terms. And typically what happens is that if you see over a longer term, market typically delivers about 20 to 25% higher than the nominal GDP growth. Well, that has not happened in last 12 years. So my view is that it is just catching up. So 13,000 is just a number. So I was doing some math yesterday. So I think that where the index should be, if you consider, forgetting about the 20% additional growth, only if you consider that it has to catch up with the GDP growth, market should be somewhere around 14,800 to 15,000. So yes, we are there. People are saying we are 80% of the GDP. The market cap is 80% of the GDP. But you also have to realize that GDP is also, slightly constrained at the current junction. And if you consider about, say, 8% growth next year, I think 14, 15,000 will not be difficult. Now, having said that, the pace of movement has been really fast in the last few days. And it is quite possible that the market may react, or you can say there may be profit booking and there could be some cooling down of the market. But as I always say, if you are in India, you need to be positive about the markets because you are a country very young when it comes to GDP growth. So there is a long way to go. But yes, I agree with you that the pace has been very fast and there could be some kind of a cooling down.
Okay, I don't intend to spend this conversation talking to you specifically on milestones and short-term moves and all of those things. But I do want to ask you a couple of follow-up questions on what you've just raised, right? I think one point being that if you look at the valuation, especially of the index, it does seem at this point that maybe we're a couple of standard deviations higher than ordinary or historical valuations.
Yes.
So is that something that concerns you, or do you only see as a function of the narrowing of the market? And then I have a second follow-up question once I have your response.
Yeah. So yes, to some extent, it's the function of narrowing of the market. That is one. But the second is that P's are again something which you should look for, in the future and not the current P's. Current P's are absolutely impacted because of COVID and a lot of other things. And over the years, I have seen that as things improve, the consensus P starts moving up. So this time won't be different. That's what will happen. So I'm not too much concerned about the high P's the market is trading at. But profit booking is quite a possibility because many stocks have run up quite a bit.
Okay, fair enough. The other point that I wanted to put to you, Milind, is that there is a little bit of contradiction out there on whether we can continue to see this kind of momentum, not just in the Nifty stocks, but in the broader markets as well. There are those that argue that the central bank taps across the world are going to stay open. There are those that find confidence in the fact that Janet Yellen is likely to become, the next finance minister of the US, so to speak.
Yes.
And she understands what it means for the fiscal side to pick up as much of the burden, having been on the monetary side. So I think there are those who believe that. There are others who believe that the vaccine news is priced in. that the immediate recovery in economies across the world, including in India, is all priced in. In fact, we're now slowly starting to see some degree of bullishness in oil prices. And so they believe that most of this is priced in, and therefore there is going to be a slowing down of momentum. The reason I'm asking you is because I want to know if veterans like you are sort of rejigging portfolios a little bit to keep some of these factors in mind.
Okay, so one thing is definite, that low interest rates are here to stay. I don't think the interest rates will move up in the shorter term. Even in the longer term, I doubt very much whether the global interest rates are likely to move up. In India, there is a possibility that interest rates may move up maybe 6-9 months down the line. But then again, we have seen way back, if you go back to 2002-3, the real growth in economy comes in when the interest rates start moving up. So that is what could happen even this time. But yes, there could be some kind of a sector shuffling which can happen. But as far as I am concerned, I believe that any sector which does well in a country like India, where you have a 6-7% GDP growth and 4-5% inflation, that's the sector to be in, and just a buy and hold strategy works better.
Okay. In your last conversation with Neeraj, which was a couple of months ago, before we had seen the scale of recovery here locally in the Indian economy, and before we had seen this pace of foreign investment either, you spoke of a portfolio made up of relay runners and marathon runners. And I'm sure this is, sort of the conventional wisdom amongst many experienced market investors, that you have a bunch of stocks that see you through over the course of like 5, 7, 8 years, and then some stocks that provide the icing on the cake. How do you approach that portfolio at a time like this? A, do you rebalance the proportion, considering that next year you might want to relook at both momentum, at flows, at pricing, at valuation, or do you leave it untouched?
So it's like this, that, marathon runners continue to be marathon runners, and the portfolios which we construct are significantly weighted towards the marathon runners. There could be a few relay runners, and typically, so in my view, what happens if you take a very long-term view, the way market cycles behave are something similar to Darwin's theory of evolution, in the sense that first the commodities move up, then the commodified products move up because commodities start coming down, then the industrial products move up, and it goes on. Then the consumption stocks move up. So that is what happens when the market, all the stocks start participating in the market. And I think that is what we are seeing now. That is what we saw in the last bull run of 2003 to 2008 as well. So I don't think this time it's any different. I think the same. So the relay runners typically would be economy stocks or economy dependent stocks. So they could be, we are seeing commodities moving up right now. There could be chemicals, then there could be industrial products, engineering companies, and so on and so forth. So these will be the relay runners. When it comes to marathon runners, I continue to believe that anything to do with consumption. So whether it's pharmaceuticals, hospitals, finance, FMCG, retail, white goods, all of them will be marathon runners, and they will continue to be the marathon runners.
Okay, one last macro question before we talk about your views on some of the broad sectors and areas of consumption. Earnings has surprised on the upside this time. I'm talking about second quarter. If you take a look at the BSE 100 sales growth, it bounced back to about 2%, year on year. This is versus about 18 or 20% decline in June. Banks and financials, insurance, IT, autos, telecom, they've all done very, very well. EBIT was up 16% year on year. And this is a third of the firms seeing profits grow, approximately 30% plus. Now, do you consider this quarter sort of a big comeback recovery quarter and hence an aberration, and don't let it influence at all any of your portfolio picks or your investment choices? Or do you actively look at the earnings and try and pick out those companies that have ridden out this recovery cycle in better shape than others, and maybe rejig your portfolio to include them?
So if one looks at what has happened in this quarter is that, as I was saying, the economy driven stocks or the typically the commodities have given the kind of returns which you are talking about, 30%, 25% kind of growth, while as those which have not delivered the numbers are all consumption driven stocks. So that is what it is. And I don't think just because of a quarter, we will change our investment strategy. But one thing is definitely clear, that it's a clear indication that economy has started to recover. In fact, the RBI in its latest report has also said that there is a possibility that third quarter could, the economy could end up with a positive GDP growth. If that happens, then it's fantastic. But when we talk to the companies which we are invested in fact, all of them, especially on the consumption side, say that we would be surprised if we were not able to return to normalcy in the fourth quarter. Of course, everyone is putting a rider to that, which is, of course, that we don't see a big second wave. So probably the fourth quarter is going to be normal, and we will be exiting at about 4.5% growth for the quarter. If that happens, I think we are back again, and plus with the kind of money flow which is coming into emerging markets, I think that will support the continued growth in the stock markets as well.
Anything surprising that you noted in these earnings, Milind? Performance or results that you were not expecting either from a sector or a group of stocks?
So let me be frank. The last time when I had talked to Neeraj, he was quite bullish on technology stocks, and I said that probably I don't think this seems to be one time. But after listening to the commentaries for the second quarter and the performance, I think there has been a change in technology stocks, and frankly, we have added a couple of technology names to our portfolio. Thanks again, Neeraj was right, and he did probably identify them far ahead. So yes, that is one sector which surprised us. But apart from that, as far as commodities and other things were concerned, our analysts were tracking them, and they were indicating that we are in for a good quarter, good second quarter. So yes.
IT stocks are richly valued. How did you pick what you had to pick, Milind? I know you can't share names, but what did you exercise in terms of parameters before picking what you wanted to be invested in?
So we focused more on companies which were unique in the sense either they were working on platforms or they were working on let's say digital and cloud. So where maximum earnings were coming from them, because that is where we thought there could be a business traction for next 4-5 years.
Okay. To talk about some of the sectors that you've traditionally always been invested in, and some that have borne out this pandemic year, a little well as well. Like, for instance, FMCG. But even within that universe, or FMCG and consumer, let me expand that. Category-wise, the performance has been rather uneven. The financial performance, the sales, revenue, top line, bottom line growth. For instance, things like food have been resilient and done well in the last couple of quarters, even in quarters when we saw a 23% drop in GDP. But others like home care or quick service restaurants, QSR, or footwear, or even liquor, they've not done very well in the last 2 quarters, and they have a lot of catching up to do. So within the consumption space, do you now reorient how you look at some of these subspaces?
So yes, we are looking at reorienting, but within that, we continue to like food because that we think is a large opportunity. But having said that, I don't think the kind of growth which they delivered in especially the first quarter as well as a bit of second quarter is likely going forward. So we may see some kind of a toning down of this growth coming in the subsequent quarters. But the opportunity is large, so we continue to hold them. As far as FMCG is concerned, there could be some churning which probably needs to be done, because some are large players, and once the routine, of course, one thing is definite, that they have been impacted because of stay at home, especially when it comes to cosmetics and other things. Definitely these companies have been impacted, and as people start moving out, these categories could do well. But I think these categories also are well penetrated. So a growth which is higher than GDP is slightly difficult in these spaces. But in food, I think there is still a lot of opportunity, because as people or as families, as couples, both of them are working. There is a lot of demand for ready-to-eat foods and things like that. So that is the sector where we think the opportunity lies, more than an FMCG sector. Of course, there will always be an exceptions in both.
Okay, but if you were to reorient it all, like for instance, do you think that if we saw a return to normalcy by the fourth quarter, that QSR or liquor or any of those spaces then start becoming much more interesting? How do you approach those spaces, or do you say, wait till I actually don't see people going out to restaurants or being able to consume out of home, outside of home, not out of home?
Yeah.
That I will not consider these sectors at all?
No, so not really. I mean, one should invest when the valuations are down, because you will have to take a call or a bet, if you want, that we will get over this pandemic. And if that is true, then obviously these companies will do well. They have not picked up as much as the other sectors. So one should be looking at these sectors, whether it's QSR or liquor or any of these stocks.
But typically in your entire portfolio of, let's say, consumption-oriented stocks, what is the kind of weightage you'd put to, let's say, food, which you believe will prevail over the next several months? And then maybe some of these, recovery stocks that, as people get out of their homes, will give you that little bit of extra, sort of gain.
So last time when I spoke to Neeraj, I said we are invested in hotels. And,
yes, I remember that.
Yeah.
Yes.
So
and look at what hotels have done in the last couple of months, right?
Yeah. So that is one post-COVID play, you can say,
right.
that we think the entire sector, whether it's pick up any hotel, I think they will do very well, despite the fact that international travel will take some longer time. But I am already seeing a lot of people taking staycations, which is quite interesting. In fact, the other day we were talking to one of our investee company, and they said they are already at 45% occupancy, which is very interesting. In fact, Goa practically is full. So things are coming back, and staycations probably will be the way to go for at least 6 months from now on. And after that, I think hopefully international travel will also return. So hotels is an area which seems quite interesting. Even theaters could be interesting, though right now people are still worried. But I'm also told that people are fatigued of these internet platforms.
Watching things on their phone.
Yeah, Netflix and a lot of other things. So probably even theaters could be a good option.
And how do you time this, right, Milind? Because I remember talking to PVR about a month and a half ago, and they were waiting for theaters, multiplexes to open nationwide, which is going to happen in a phased way. Then we see these local lockdowns happening state to state. Plus, there is at this point no new content, because no film producer wants to release a movie. If they're not certain about audience is coming back, they're not even certain about those multiplexes staying open for the full week, because some local lockdown will, sort of impact that. So how do you time these, or do you just, invest and wait and hope that in the next 30, 60 days things will change?
So we don't trade. So in the way we operate is that we look at a company and we see where the debt is the lowest. In fact, most of our invested companies are zero debt or very low debt. So that's why they have survived pretty well in this downturn. But even in the hotels and theaters where debt is likely to be there, look at a company where the debt is low and invest, and then wait for the pandemic to get over. There is no other way out. And that's why you're getting it at these prices, which are probably 50-60% lower than what they used to trade earlier.
Okay. The one space that you haven't discussed, in previous conversations is the durable space in consumption. And I'm wondering if you have any thoughts on how you view that.
So we are invested in a durable company. And we do believe that durables also is a big opportunity. Because if you take ACs, I mean, in terms of penetration, India is extremely low penetrated across all the durables. So there is a huge opportunity. Who will win the race? Very difficult to take a call. So either you play them through the actual brand holders, or you play them through the contract manufacturers. Either ways, but the opportunity is large. So whichever company or sector you are comfortable with, go ahead and invest. I think, but that's a space which one should be invested. That's one of the marathoners, according to me.
How do you navigate externalities, Milind, in a space like this? For instance, all the trade changes that have happened, the import bans or prohibitions on certain parts, or even on wholly assembled units from China or other countries. And we've seen this as a constantly changing space. So therefore, how do you sort of factor that in? And therefore, what do you pick?
So let me take air conditioners. Now, if you go back in the United States history, the maximum growth of air conditioners consumption or air conditioner purchases happened when electricity reached everywhere. So it's not always that people cannot afford air conditioners, but if you don't have electricity, or if you have electricity which is intermittent, there is no point in having an air conditioner. Now that we are seeing electricity reaching every part of the country, and probably we will have a stable electrical supply, we think that these things, so this is universal, whether there is a 5% duty on, say, compressors, or 7% duty on the part which you have inside your home. That's all. That applies to everyone. There will be a slight benefit for people who manufacture it in India. Interestingly, I think a couple of Chinese manufacturers have also started manufacturing in India the parts. So to that extent, there will be less impact of these things. And even if this impact is there, it is across the board of 3-4% increase, or even less than that. On the overall machine, I don't think will impact the demand for it.
So these are neutral events, is what you're saying. You don't consider them to be game-changing events in how you sort of pick stocks in this area over a period of 2, 3, 4, 5 years.
Because as your per capita income goes up, your affordability goes up. So that's the whole idea.
I haven't heard you talk about autos at all. It's been a very, very confusing space to read over the last year or two. We've had issues with inventory overstocking. We've had issues with demand coming down. Then, of course, this year, now that mood seems to change a little bit. People are saying in the short term, people will want to own their own vehicle because of this pandemic situation. And the festival demand for autos seemed all right. Maybe not as good as most people had anticipated, but all right. How do you read that?
So autos could be an interesting space. I don't deny that. So we have played auto through an auto ancillary. We have not bought an auto company directly, but we have bought an auto ancillary, and we're holding on to it. We are making some money also in that. The thing is that autos again go in cycles. So we have seen this 50% dip in or 60% dip in M and HCVs, and 30-40% dip in passenger vehicles way back in 98, 99 also. And after that, things turned, and auto started delivering the numbers which they did for a very long period of time. I don't think this time also is different, and same thing will happen. But I think the pace of growth in auto, I doubt whether it will ever reach very high rates, mainly because of the infrastructure issues. But otherwise, that urge to own a four-wheeler or a two-wheeler will always be there, because in India, or I think even globally, it's considered as a status symbol, more so in India. So to buy a four-wheeler and keep it under your building without driving it, or driving it only on Saturday, Sunday, is what most of the Mumbaikars do. And that will continue to be there. So, but I think they will be market performers. I doubt whether they will be outperformers.
And you feel that even about the two-wheeler space, Milind?
Yes, because two-wheelers, I mean, if it's more of an anecdotal evidence, as Peter Lynch used to say, that you need to look around yourself. Yeah. Most of the parking spaces these days in and around, at least my building, is completely filled with two-wheelers. Even if I go to my Pune house, we see that, you have to navigate through these parked two-wheelers. Of course, Pune is a city of two-wheelers, so you can't. But you go to rural India also, these two-wheelers are there everywhere. So I think the main growth phase of these two-wheelers is over now. they will grow but again, at the GDP rate, maybe slightly better than GDP. So they, again, whether it's two-wheelers or four-wheelers, my belief is that they will be market performers rather than outperformers.
Okay. The other sector that in previous conversations I haven't heard you address, but again, which is making a bit of a comeback, right? We've seen some great data when it comes to home buying, in the last couple of months, for a variety of factors: lower stamp duty in some states, historically low interest rates, all of those things. Is real estate at all exciting to you, especially those players that are more tilted towards residential real estate? How do you view that sector?
So yes, it could be interesting, but we have not looked at residential or any real estate, player for that matter. We have been playing real estate through financials. So we have housing finance companies in our portfolios. So we play real estate through them.
Okay. Financials is core to every portfolio. Yes. Have you changed your view at all, Milind, on where you'd rather be invested in the financial space? We've seen a large number of well-known top-line NBFCs reducing their books over the last, several months, but maybe now growth will come back and help them do better. We've seen huge price corrections for some of these companies. Due to the medium and long-term change, how your money is placed?
So we continue to believe in
the top franchises.
The consumption theme. So we continue to be invested in those companies who are retail centric and who focus on retail borrowing. So we are invested both in banks as well as NBFCs, where the focus is on retail lending, and of course, as I said, housing finance company.
Okay. So one final question then. I know the last time you spoke of hotels as a great recovery sector. Is there anything else as we wind down to this year? And, you'll start hearing chatter about the budget. You'll start hearing more demands on the finance minister to provide stimulus for the next, for some real growth in the economy over the course of the next few quarters. Does any of that change your view on maybe sectors that you've either stayed out of or sectors that you thought, you wanted to exit, but you no longer want to at this point in time?
See, commodities is something which I have always avoided because I don't understand commodities.
I saw you say that in the conversation with Neeraj last time, so I didn't put in a question on commodities.
Yeah. So that is the reason why I don't look at commodities. But I think that there is still space in consumption, especially in pharmaceuticals.
Okay.
So there could be some good pharmaceutical companies, because pharma companies have three legs to their business. One is the India leg, which entirely depends on rising per capita income. The second is US leg, which of course depends on the US FDA approvals and things like that, which I think Indian companies are now have now understood what they need to do for getting approvals and not getting the warning letters from US FDA. And the third is the global leg, where they supply to the global, to the entire globe other than the US. And on all three legs, I think that governments are very well aware now that spending more on healthcare is rather better than facing these type of pandemics. So I do expect a lot of emphasis to come on healthcare spend across the globe. And that is why, whether it's pharma or hospitals, both of them could be very interesting space for a long period of time. Shorter term, I really don't know. But longer term, yes, this space could be very good.
Okay. So Milind, if I was to distill, and I'm not trying to distill the views that you've shared on certain areas of consumption or sectors, but if I was to distill your broader view, given the milestones we've made in the markets in the recent few days, you are undeterred in terms of the amount of money you'd be putting to work. At this point in time, even if there are, let's say, medium-term bumps or short-term bumps, you believe that your investment outlook remains unchanged over the course of the next year or two?
That's perfect, Menaka.
All right. Milind, thank you so much for speaking to us this morning. And thanks for being on BloombergQuint, and all the very best to you.
Thank you. Thank you, Menaka. And all the best to you too.